Hello, my name is Emmanuel Josenko. I'm the Director of Graduate Studies and Professor of Finance at Glion. So welcome to Leading Hospitality Through Turbulent Times. So this session, as usual, will be a presentation of about 30 minutes with 50 minutes for question at the end. We are taking questions in writing only, and you can submit these as we go along using the chat box. And just a reminder that the session is being recorded and will be available on the Moodle platform afterwards. So now I'd like to introduce you to our special guest today, Michel Girardin. So Michel, this is a second webinar with us. Michel teaches economy at the University of Geneva. He has more than 25 years of experience as chief economist and chief investment officer in various Swiss banks. And the topic of today will be about the COVID-19 fiscal and monetary policies implication. And I think that we will talk about some helicopters, so it would be interesting to have your views on the helicopter money. So Michel, thanks again for accepting to present the second webinar. Michel, the floor is yours.
Thank you, Emmanuel. Thank you all for joining this session. Welcome back. So the title of my presentation is Time for Helicopter Money, and I'll be discussing the fiscal, both monetary policy, but also fiscal policy in response to the COVID-19. The key issues are, we are indeed in a severe recession. We saw last time that the most likely scenario to get us out this severe recession is to have a U-shaped recovery. Some people are banking on a V-shaped recovery, but I think with the gradual unlocking of the economy, we can only expect at best a U-shaped recovery. What will be the implications on economic growth, public debt, inflation, of these economic policy tools which will be enacted both on the fiscal and monetary policy side? So these are my 3 points which I will address. A brief reminder from last session, the economic outlook for the major country. We see here the bars, the blue bars going down. This is the estimated growth for this year. So we're talking for the year as a whole of anything between 5 and 10% for some countries like Italy or Greece, 10% fall for the whole year of GDP. That's clearly sizable. But then some countries, like you see here, I'm going to put my laser on. You see here, this is China. China will experience a positive growth, so very sharp drop that we saw in the last session in the first quarter of the year, but then the economy is already recovering. It's clearly not at the same capacity as before the COVID-19, but it is indeed recovering. So for the world as a whole, we can expect here to have a recession, a fall of anything between 2 and 3%. It's massive, but we've been there before. We have had the recessions of the like. The good news about this one is that it's severe, but likely to be short. Indeed, when we saw last time unemployment, and I thought to put it more into reality, to show the number of people unemployed in a sector which is certainly of interest to you. We're talking here about leisure and hospitality in the United States. And you see here the red curve is the number of people who have been made redundant in this sector in the US. We're talking about close to 5 million people. And this triggers an unemployment rate for leisure and hospitality of 40%. This is twice as much as the average for the United States economy as a whole. So clearly it's a very bad hit for the sector. The good news is that 80% of these layoffs, I'm talking here about the whole economy as a whole, is 80% of these layoffs are temporary. On a personal note, my son is a cook here in a restaurant in Geneva, and just today, the good news after more than 2 months lockdown, he has been able to start again working, and he's really happy, and his dad as well. So let's hope that things will improve gradually everywhere, and going back to business or in leisure and hospitality. I showed this chart last time, and so here the idea is to provide you with an update. The correlation here between the stock market worldwide, you see it tumbling by 35% since the market started going down in February, mid-February, and then recovering up 30% from the low here. And this coincides with the peak of mortality in the number of people dying from COVID-19. Clearly here, the statistics are not always reliable. Now we know that the center of gravity has moved to the US and Latin America, and we don't always have reliable statistics to really quantify the evils of the COVID-19. But clearly, and I take here the example of Switzerland, the trend is clearly towards improvement, and we're seeing light at the end of the tunnel. Now, let's start with the first tool, which is put into practice, put at work today to really make sure that this recession does not become a depression. And this is the big mistake which was done in the 1930s, and I come back to that. So clearly now, when you ask, and this is a survey conducted to various households, and you ask people whether the government's actions are enough, go too far, and not go too far enough. And you see here that the bulk of the people either believe that this is right, and here we'll see that in a minute we're talking about massive expansionary policies already, and also a lot of people think that this is not going far enough, and very few people believe that the measures are going too far. So there's clearly a call for fiscal action. So how much is the COVID-19 bill going to be? Here, when we do the aggregation of all the plans which have been carried out worldwide and announced, and we're talking here about both on the spending side, the government spending, revenue measures, tax incentives, and then we also talk about loans, guarantees, equity participations of the state. So all the action from the governments, how much is that going to be? Well, we're talking here, and I put the number here, we're talking in total of about $9 trillion. That's $9,000 billion. The bad news is that this number has been revised upwards. This is produced by the IMF, and it's been revised upwards by 1 trillion. So an increase about roughly 10% from a month ago. So clearly we would not like to have this kind of adjustments every month. But is it a lot? Is it a little? Let's see some numbers. Here, you hear many people saying we're not going to be able to afford paying the bill, footing the bill. Why? Because the countries have already a lot of debt. Look here, this is the Eurozone on the scale here, and we're talking about government debt in relation to GDP. And you see here we're at roughly 85%. Look at the US, also here on the left-hand scale, we are at 110%. This is before the COVID-19, right? And the worst here, Germany is good. Germany, there's a lot of pressure, but you will see that it's the country that is least willing to to actually do some fiscal reflation. And then we have Japan. Japan is on the right-hand scale here. Look here, the number is appalling. It's 200%. So many voices are out there saying, we won't be able to pay for it because government debt is already too high. Now, if we look at the G20 country as a whole, then we find some interesting statistics. You look at the evolution of the GDP, so total economic activity of the 20 largest countries in the world, which together account for roughly 85% of world GDP. Now, this is the evolution of GDP. This is in red, the evolution of public debt. We're talking here of $1 trillion. So the size of the total here economy of this G20 is a roughly $115 trillion or 115,000 billion dollars. So a lot of money. Now, the key thing to look at, which everyone looks when you want to assess whether fiscal policy is correct or not, is this ratio here. It's the debt to GDP ratio. And here I indicate it on the right-hand scale. Now you see here, we're standing at roughly, for this G20 country as a whole, at 90%. So that's in a relation, it's a kind of average between the 200% of Japan, the 110% in the US, 85 in the Euroland, and so forth. So you will get to this number here. Now, this is a prediction I can make based on the numbers I have, these estimates I got from the IMF, and I put here this forecast. You see here, the number will increase from 90% to 105%. This is a combination of both this increase by $9,000 billion as a whole for the whole economy, which will impact here, and also the fact that GDP is going down, because this ratio, the bad news about this ratio is that it increases both if the numerator increases, if debt becomes larger, but also if GDP falls, if we get into a recession. And I'll come back to that. So, but once we get this impact here, then in 2021-22, we'll go back to something which is much more affordable. So when we look at this increase here, the conclusion is it's manageable. Why? You compare that, there are many points we can raise, but certainly one is comparing the increase in this ratio we experienced during the last recession in 08. You see here, the increase was much more pronounced than what we can expect right now. Of course, we're talking about a different base. We're starting from a different base. But what matters is not just the size of the debt to GDP ratio, but also the evolution, how these evolve. And indeed, what...
So Michel, just one point, so just to clarify, so here the point is that this debt ratio will decrease afterward because the growth, in fact, will come back, right?
Indeed.
Okay.
That's the good news about these ratio is that, and we see illustration of that. You can see already one example here. You see here, the ratio here comes down, not because between 2004 and 2008, not because we have an austerity plan. Indeed, you see debt is increasing during this period, but GDP is increasing faster. So we have the numerator increasing, the denominator increasing faster. So that means that the ratio comes down. And this is, we'll come back to this virtuous circle of having more debt, but that triggers even more growth, and in the end, you're better off and your debt to GDP ratio falls. And indeed, this is one example that we can talk about during the 1930s. The 1930s, if you recall, 1929, we get this huge crash, financial crash. And then we have President Hoover, was at the time, he was obsessed with balancing the budget. So he was really favoring austerity. He said, the financial market got a crash. That's not my business. My business is the economy, and I want to balance the budget. So he cuts subsidies, he raises taxes, and he really strives to curtail the expansion of the public debt. Public debt does increase, but GDP collapses. So the debt to GDP ratio more than doubles under Hoover. Then in 1933, Hoover was a Republican, comes a Democrat, Roosevelt, and he says, New Deal. He's a Keynesian. He believes in kickstarting the economy with, spending, government spending. And look what he does here. Public debt under Roosevelt increases by 62%, but GDP increases by the same amount. So the debt to GDP ratio stays the same. So this is clearly what we want here, is to find the right balance between increasing debt and having the GDP also expanding. So all in all, the debt to GDP ratio stays the same, or indeed can even fall. And indeed, this is one example we had during the 30 glorious years, as we call them. This is the post-war boom we experienced between 1950 and 1980. Look here, this is the US GDP in green, going up on a cumulative basis, $1 billion. This is the same for the public debt, government debt. And here you see that famous ratio again on the right-hand scale. And look here, we're starting in 1950 at roughly 70%, that ratio, debt to GDP. And look here, it's falling. It's halving, it's cut by 2 from 70 to 35. Not because we have had austerity. Indeed, the debt is increasing, but we get a real boom of the economy. And so, again, that denominator is rising faster, and so the ratio can fall. Now, clearly, you all think, how can we get there? How can we get to this miracle, of spending more and in the end having a less indebtedness in relation to economic growth?
So Michel, before you go on,
yes.
That's basically here the one insight is that public spending must be counter-cyclical, right? Not pro-cyclical. So that means it's a tool that you will use to counter, in fact, the GDP evolution. So it's your example with respect to the 29 years, 30 years, where there were first an approach that was basically to cut spending when you get in recession, which is not the good stuff to do, obviously, because here you're adding, in fact, recession on recession. And the Keynesian approach, which is, in fact, to take the other way. That means it's in bad times that you need to spend more, and it's good time that you need to reduce it, right?
That's right. That's right. Yes, indeed. Fiscal policy needs to be counter-cyclical, needs to be enacted when you have a depression, just like the case or a severe recession, just like we're having now. And here, this period here I'm talking about is the post-war boom. So we then clearly needed fiscal expansion also to recover from the war period. Indeed, here, this virtuous circle, which I alluded to for the G20, you can also see it for the Eurozone. Look here, we have over the recent period, this is pre-COVID-19, the government debt, which everyone talks about, a lot of debt in the Eurozone. Yes, okay, it's increasing, look here. But then GDP here is rising even faster. And so here, okay, the magnitude is not that huge, but we're talking still about a fall of that government debt to GDP ratio from 93% here on the right-hand scale to 84 between 2013 and 2019. So you don't, the message here is that you don't necessarily need to have austerity plans to curtail debt. You can also have increasing debt, and that ratio, which is the key thing, the ratio which remains stable, or indeed can even fall.
If your public debt is able, in fact, to create more growth.
Indeed, and it all boils down to this fiscal policy multiplier. Basically, what do we mean by here? We want to measure the effect of an increase in government spending or a decrease in taxes and the impact it will have on growth, on GDP. The concept here was first developed by this famous economist, John Maynard Keynes, and his followers in the 1930s. And here at the core, the underlying concept here of how this works is the idea of what we call marginal propensity to consume. Now, what do we mean by that? It's like with taxes, you know, we talk about marginal tax rates. So it's the tax rate you pay on an additional income. Here, it's your additional consumption, your new consumption, if you suddenly get a check from the government, like Trump wanted to send a check of $1,000 to each American. So the idea is how much of that $1,000, not of your whole income, but that $1,000, are you going to spend and how much are you going to save? So that's the marginal propensity to consume. So let's take one example. You have a fiscal multiplier to illustrate how we get there. Assume the government says, okay, we're going to have 1,000 here at say, okay, 1 billion, okay, fiscal stimulus plan, and this marginal propensity to consume is 0.75. So what you're going to have is that you're injecting $1 billion in the economy. Sorry, I have to cut my window. I have some work. Can you hear me all right?
Yeah, fine.
Okay, great. So the marginal propensity to consume is 0.75. So that billion you inject is going to, people are going to save 250 million and spend 750 million. So this spending will trigger another smaller round of stimulus, right? If you're spending, people go to the restaurants, then that money will also be spent by those who receive it using this marginal propensity to consume. So the recipients of that will spend 75% of that, which is 565 million, and so on. So in the end, the total stimulus, you can figure out, adding all the sums of these with this 75%, it boils down to this. It's 1/1 minus the marginal propensity to consume. So in our example, the multiplier will be 1/1 minus 0.75. It's 4 times.
So if I just go back to your example, Michel, so it just means that if you have this MPC, which is 0.75, so you got 0.25 of leakage, right? So when the government is putting $1 in the economy by spending, so people will basically consume the 0.75 cents, right? So yeah. They will go, for instance, to the bakery, and with that, they will buy stuff. And then the guy which is sending the stuff will, with this money, spend again. And so you got this cycle. So you got this nice feature, which is basically with $1 you put in the economy, you will have a multiplier effect because you have a change of consumption, and basically this is what you're presenting. So the final effect will be 4 in your case.
Times. Yeah.
So what is important is obviously that the saving is not too high, because if people, when they receive the money from the government, are saving a lot, then you don't have so much multiplier effect. But if they consume a lot, then you have a high multiplier effect.
That's right. So then the real question is, okay, this is a theoretical example. Now, how much can we estimate this fiscal multiplier to be? Here are some estimates which are being conducted right after the great financial crisis of 2008. They've been conducted by Moody's, and this is not based on the marginal propensity to consume. And basically, you see here, this is the fiscal multiplier. So that compares to that 4 I showed you just now a minute ago. And indeed, you see here that the fiscal multiplier is much bigger if you're talking about spending, you know that the fiscal policy can work through two levers. One is tax reduction and the other one is increased spending by the government. So you see here that the fiscal multiplier is much smaller when you're talking about tax cuts than when you're talking about spending. And the reason is simple, and I put it here. The reason is that here you're talking to these measures like cutting corporate tax rate or make dividend and capital gains tax cuts permanent. You're talking to the high income population. Whereas here, especially look here, the temporarily increase in food stamps, 1.73. So this is clearly here you're talking to the low income population. And so here their marginal propensity to consume is clearly higher than for these people here. So this is why when we really want to have a big impact on GDP, we want to have a fiscal multiplier which is greater than 1. Greater than 1 means that you get into this virtuous circle of having rising debt, but the fiscal multiplier being larger than 1 will have a bigger, proportionally bigger impact on GDP. So the GDP, the debt to GDP ratio will fall. So this is very interesting, and it clearly applies to the current situation. We're not talking about fiscal reflation for these people here. We're talking about aids, helping the poor, helping the low-income class to really get additional help from the government. And so this is where the fiscal expansion here will be most effective.
Michel, can you just define to the audience what is reflation?
Reflation is expansionary. When we talk about a reflationary policy, we're talking about a policy which is expansionary. The other key point of debt is whether it is sustainable. And to measure that, we have to look at how much we're paying for the debt. Here I show you a chart which is the total debt of the US in relation to GDP. And these are the bars. Remember last time I showed you some charts with vertical bars and they indicate recessions. These are the recessions in the US. This is by total, we mean here the total of government, households, and the corporate sector. So here, look, and this is on the right-hand scale, look here, 220%. So that's 110 for the government, plus again 110 between the households and the corporate sector. Now, the key thing to look at, if I look at this chart alone, the yellow line, do I have a reliable indicator that tells me this is too much and we're going to have a recession? No. Why? It's very simple. Look here, this is a recession, this is a recession, this is a recession, this is a recession. Here we look at total debt of 110. Here total debt of 160. Here again same, and here total debt of 190. So it's very hard to make a call for saying debt is too high. It's much better, if you want to make that call, to look at how much you're paying for that debt. This is way more important. And by that, we mean the total debt service, and this is the cost of debt and its interest rates. So if interest rates are too high, then you get problems. And indeed, here you see, I've identified this 15% trigger of the total debt service of all these three debts. And whenever we get above 15, then we get a recession. Then it spells problems. Here it works here, works here. Now this is rising. Here, obviously, there's a bar missing. We are indeed in a recession. But the good news, and this is what makes me also confident that the whole thing is manageable, is that interest rates are really low. They are really low in the US there, and you'll see that here. Look here, these are 10-year government bond yields in various countries. This is the US here in yellow. You see here, the 10-year government bond yield now in the US is 0.66 today. It used to be 15% back in the 80s. It was even here at the start of this chart here in 08, it was above 4, it was close to 5%. This is an interesting chart actually, because I put here two dates. One is when the sovereign crisis started in Europe in November 09, and this is when the Greek minister Papandreou said, you know what, the public deficit is not going to be 12, it's not going to be 6% as you expect, but double that. So wow, this is when people started getting really scared, and they realized that maybe holding government bonds from Germany was not the same as holding government bonds from Italy, Spain, or Greece. Indeed, here, look, this is the Greek bond market yield, but it's on the right-hand scale. It starts here when Papandreou makes that announcement. It is at 5%, and it goes. It skyrockets to 40%. 40%. This is when the debt becomes unsustainable. It's when it's too expensive. You cannot pay for it. I grew up in Italy, and this is the Italy bond market yield. Here you see here it's at 7%. When the government bond yield is at 7%, Italy has a debt to GDP ratio of 120%. Clearly, it's a lot, but if you can pay for it, that's okay. Here, there was a lot of pressure. Here, everyone was betting that the euro would be imploding. Then comes Super Mario Draghi, and he delivers a famous speech, which has made him a legend in July 2012 in London. He says, we'll do everything it takes to preserve the euro. And he adds, and believe me, it's going to be enough. And the people hear that and say, okay, we can buy Italian bonds, we can buy Spanish bonds, we can buy Greek bonds. If there's a problem, the ECB, the European Central Bank, will save us. And then look here, this is the speech of Draghi. And look here what happens to bond yields afterwards. They collapse, which means that the price of bonds increases, and which means now that the whole thing is manageable. So this is the very good news. And here, look here in Switzerland, bond yields are even negative, in Germany as well. So people say, these are the two countries with the lowest debt to GDP ratio in the world. And they are paid, the governments are paid to do fiscal expansion. You know, I have to give money to the Swiss government for the privilege of lending money to the Swiss government. So clearly here, there is scope for fiscal maneuver. Okay, let's talk now about central banks. So the conclusion from this side, the fiscal policy side, is that I believe that the bill, this 9,000 trillion that you can estimate for the economy as a whole of fiscal expansion, is manageable. Why? Because the debt to GDP ratio is okay, and it's not going to increase by as much as it did after the 2008 crisis. That's reason number one. Reason number two is that the recession will be severe but short, so the debt to GDP ratio will increase somewhat, but then as we get the recovery, it will fall again. And reason number three is the one I just mentioned. Interest rates are very low, and so that makes the debt affordable.
But Michel, this is also, so it's a very optimistic view, right? But there are also risks which are associated to it, but we will talk at the end of your presentation. Yes. But basically, if you're a bondholder, the duration, the sensitivity of your portfolio will be a function of the level of the yield, right? So my guess is that if there is any pickup for any reason about the yield, the losses could be severe for the one which are already holding the bonds.
Indeed, you're right. If now bond yields are very low, the thing is that governments will all come now to the markets and willing to issue bonds, and so there's going to be a competition between the US, Europe, other countries, also emerging market countries. So there's likely to be some tensions, some competitions, and you will need to offer higher yields to attract capital. But I believe, and we can talk about this, bearing one major risk which I see, but it's a black swan, so it's very unlikely. But if it happens, it's a major damage. So unless we have that kind of hyperinflation risk, which I will talk at the end of my presentation, the increase in bond yields should be manageable. So, but clearly, if today I would need to advise people what to buy, if it's government bonds or equities, I would favor equities, because government bonds are extremely expensive. The yields are extremely low, which means that the price of government bonds are extremely high. So as you say, with the duration, if bond yields increase, you will lose on your bonds. Here, the good news about this this economic environment, which is currently very in a recession mode, is that inflation expectations are going down. Here, the inflation expectations for these various countries, you see here the US at 1%, Eurozone also down lower than 1%. You have the UK, we have Japan, which is close to zero. So this is very important for central banks. I did my PhD in Lausanne University with a professor who then became the vice chairman of the Swiss National Bank, and he told me, if there's one chart we're looking at when we are at central bank, it's this one. If there's one thing which would make us change policy from the current expansion we're doing, it's this. If we suddenly see inflation expectation going up, we will backpedal, we will reverse our policy, and we'll stop all this QE, because they're really scared about inflation. So what central banks have been doing is, that's the good news about the lack of inflation, is that it opens the way to monetary easing. Basically, central banks, I say, let's go. We can ease monetary policy as much as we can, as much as needed. And look here, this is the US. Right before the COVID-19, it had started increasing interest rates, and then it reversed already before the COVID-19, and then obviously when we got the COVID-19, boom, it brought them to zero.
Just Michel, to take one step back. So what you mentioned is if we are looking to fiscal policy, basically what the government can do, they can play either on the spending side, so that means the government is spending more publicly, or they can reduce the tax. So now if you got a second arm just to sustain the economy, which is, as you mentioned now, the Federal Reserve, the central banks. So what are the instruments that typically the central banks can use? Here you are presenting interest rates. So basically, how central banks can help the recovery?
They can use two levers. The first one is this one, is interest rates. And when you get to the floor of interest rates, normally a central bank cannot put interest rates in negative territory. But that's the theory. In practice, it does. It does so, and here you see an example. Switzerland, interest rates are negative, in the euro area as well, and in Japan. Negative interest rates.
Meaning, sorry, Michel, that if I'm decreasing the interest rate, then what is the idea which is behind that? The idea would be less costly to borrow, and the expectation will be that people will spend more?
That's the idea, yes. The idea to put interest rates in negative territory is that basically you're doing what we call fiscal repression, and meaning that you're penalizing the savers. With the message is, instead of keeping that money in the bank account, if you keep that money in the bank account, you're going to be penalized. You're going to have to pay negative interest rates. So go out and spend it. So that's the idea. So it's the ultimate, it's the nuclear arm, should we say, nuclear power of saying, you know, trying to really help the economy is by putting those interest rates in negative territory. There isn't even now talks from some central banks to use digital currencies and to have even more scope to use this weapon of negative interest rates. Why? Because if money is digital, like in some countries, for instance, in Sweden, cash is disappearing fast and people are increasingly using digital currencies. If all money is cash has disappeared altogether, then if the central bank puts interest rates at -2%, then you're paying that -2%. This is like a tax you're paying on your credit card, and there's no way to escape. Here, if I am not happy with paying 0.75% negative interest rates on the cash I keep on my bank account in Switzerland, I can go to the bank, withdraw that cash and put it in a safe or under my mattress behind me. There's lots of banknotes out there. Indeed, this is quite funny. Do you know, Emmanuel, how many for the notes and coins in circulation in Switzerland, what is the proportion of 1,000 Swiss franc notes?
Must be big.
It's big, yes. It's 70%, 7-0. Now, when I go shop at the Migros or the Coop, I don't see many people using 1,000 notes, especially nowadays, to pay for the food. So most of that money is actually in the safes. So people are escaping that negative interest rates by taking the money out of the bank accounts and putting in the safe. And the Swiss National Bank knows that. So clearly here, this is a limitation to digital currencies, but that's a separate subject. I'm actually writing a book on this, on the future of money, and addressing also digital currencies and talking about that. But that's
Michel, you were talking about two levers. So the first is
first, that one, the second
interest
one.
rate.
Now, that's the second one. The second one, once you get to the zero bound, the zero lower bound, as we call it, then you can use here with interest rates. You're acting on the price of money. The price of money is interest rates. When you're at the lower bound and you cannot reduce them more, then what you do is you act on the quantity of money. This is why we're talking here about QE. QE stands for quantitative easing. So here, basically, the central bank is injecting directly liquidity in the system. In the first case, it's lower interest rates with the idea, and I'll come back to that, for banks to provide more loans to the economy. And here, basically, the central bank is purchasing bonds which are held in the banking sector, and it's purchasing those bonds with money. And this is how it injects money in the system. And look here, this is a recent chart which shows how the total assets of all these central banks, Federal Reserve in the US, European Central Bank, Bank of Japan, Swiss National Bank, Bank of England, and how they've been expanding their balance sheet, how the central bank total assets have evolved. The Swiss National Bank and the Bank of England are shown here. We're talking about $1 billion. So the Swiss National Bank balance sheet now is about $900 billion. It's actually bigger than the Bank of England. So little Switzerland has indeed become a very large central bank. Given the size of the economy, it's actually the most aggressive central bank in the world, because these 900 some billion represent 120% of the size of the Swiss economy. But look here, clearly the US has a much larger economy. It's on the left-hand scale. Here we're talking about now a 7,000 billion size of the balance sheet of the Federal Reserve. And look here, the Federal Reserve has just announced, actually on the same day, remember that chart I showed you, 23rd of March, the market makes its bottom and rebounds. On that day, 23rd of March, Jerome Powell, the chairman of the Fed, announced QE infinity. Basically says, we are not going to make an announcement that we inject an additional $1,000 billion. We're going to inject whatever is needed. So QE infinity, no limit. So look here, already since he announced that, look here, the size of the balance sheet of the central bank in the US goes from 4,000 billions or 4 trillions. It almost doubles in a matter of months. It's now $7 trillion. So it's a huge injection of liquidity.
And the idea which is behind is that basically the central bank will buy, as you say, bonds from banks,
yes.
Right? And they will give, so that means they will take out the bonds from the balance sheet of the banks, and the banks will have what we call reserves, so they will have money, right? And the objective will be that they will use this money to lend to the economy.
Yes, I will come to that now.
Okay, I mean, just to clarify on that.
Yeah. So here you see, this is the recent evolution. These are the same curves, but just to illustrate what they did during the crisis of 2008. Here you see the expansion of the Federal Reserve balance sheet. And so here you see that basically if you compare the size of the central bank in the US now, it's close to 5 times, it's quintupled since 2007. So here what I do is I show the total assets of all these central banks I just showed you, the Fed, ECB, BOJ, and you see this is the total size of their balance sheet. It's going from something like $3,000 billion or 3 trillions to $18 trillion right now. So huge expansions, and this is the same but monthly changes here on the right scale to show by how much they are increasing month after month. And look here, the size is now much higher than what we had at the peak of their actions in 2008. So central banks are really printing money like mad, buying those bonds and using the helicopter, injecting money in the system to really help the economy. The problem with central banks, here we talk about hawks or doves. There's lots of animals we can talk when we talk about central banks. Here what I do is I show the various objectives that all these central banks have. And indeed, you see here for the Federal Reserve, objective number 1 is maximum employment. Objective number 2 is stable prices. And then as the third, less known, is moderate long-term interest rates. So maximum employment, people who, when we say, oh, he's dovish, central bank is dovish, means they are favoring employment. This is clearly what they're doing now. When you're in the camp of saying, ooh, we're going to get inflation down the road, let's increase interest rates, let's keep monetary policy reins tight, then you're a hawk. So it's always been a fight between central banks, those who are hawks, so the inflation guys, and those who are doves, those who are favoring employment. So it's always been a fight between the two. And now we got another animal with Christine Lagarde at the ECB. She came and said, I don't want to be a hawk, I don't want to be a dove, I'm going to be a owl, in sweat, you see here. And the symbol here of the owl, why she uses that, is wisdom. So she says, wait and see, careful approach, wisdom. Indeed, and I'll tell you why I think she's right, because in the 1930s, the central banks was like Hoover, too tight. So the problem, and this is why we got a depression, the central bank was too hawkish. And now we're in the other camp. Since the mid-90s, the tilt for the central bank in the US and for most of the central banks, except the German Bundesbank, is to be dovish, so favoring employment. But clearly, there's a risk of now the central bank being too dovish, being too expansionary. There are risks out there, which I'll talk about in a minute. Before I do that, I want to illustrate, say, what is he talking about now here, bringing the horse to the river? There's a problem with central banks, and we can use it with the allegory of saying the central bank can bring the horse to the river, but cannot make him drink, no matter how hard you show him how to do it, how to proceed. Now, what do we mean by that? In French, by the way, the expression, it's another animal. We say you can bring the donkey to the fountain, but you cannot make him drink. What do we mean by that? The central bank, as we saw earlier on, reduces interest rates. When it reduces interest rates, basically the idea is that, take the example here for the US, for instance, when interest rates go from like 3% to 0, the idea is that banks will go to the central bank and borrow money from the central bank, and now it's free, right? It's at 0%. But in the same time, they keep interest rates when they lend money to the real economy, to the corporate sector, to the household sector. They keep those interest rates much higher. So the margin for the commercial banks providing loans increases. You reduce the cost of getting the liquidity, and you keep the income from your lending unchanged, or you don't reduce it as much as those interest rates here. So you increase the interest rate margin. Basically, the central bank is opening the liquidity tab, and it's telling the horse or the donkeys, the commercial banks, come and drink my liquidity, take my water. But if banks, they don't want to provide loans to the real economy for whatever reason, it does not work. This is why we say you can open the tap, but will it make the horse drink or the donkeys drink? That's a problem. And the best illustration of this problem is Japan. Look here. This is the expansion of the money supply in Japan between 1980 and today. Look, it's going from 100 to 3,000. And now look here, this blue line. Do you know what this blue line is? This is GDP in Japan. So you see here, Japan, up until the 90s, the two were moving in tandem. And then in 1990, we had a huge bubble. The Nikkei, the stock market index, was at 30,000, twice as what it is today. And then the bubble bursts, and then the economy went nowhere, and banks had bad loans up till the roof. So when the central bank injects all that liquidity, brought interest rates to 0, and told the banks, please use that liquidity and inject it into the system, make no new loans, make credit increase again, because this is what drives the economy. Banks did not do that. They used the cash to buy government bonds instead. So money did not flow. The money expansion, look here, the central bank, and you remember the chart I showed you with the size of the balance sheet now in Japan. It's more than 100% of its GDP. But that's a necessary condition, but not sufficient. If commercial banks don't want to play the credit game, it doesn't work. So this is the major problem. And there's a fundamental asymmetry with monetary policy. It's much more easier to do the opposite. If the donkey or the horses are drinking too much water, meaning if there's too much credit in the system, then it's easy for the central bank. You just close the liquidity tab. You just put interest rates at 15%. This is what the Federal Reserve did in 1980 with Paul Volcker when he wanted to kill inflation. So that's easy. You just close the liquidity tap. But if you have the opposite problem like now, and you want those banks to provide more loans to the economy, but if banks don't want to play that game and they'd rather invest that money in the capital markets and buy government bonds instead, so borrow money at 0 and buy government bonds at 0.5, which is what Japan has been doing for the last 20 years, then the economy goes nowhere and we get this. So this is clearly a major problem. And we talk about a Japanization risk, even in Europe, that we get this missing link between central banks and the real economy. So this is one reason actually, which is pushing people to say, okay, QE via the banks sometimes, or more often than not, actually does not work. Let's try something new. Let's try QE for the people. QE for the people. This is exactly what I was referring to earlier on when Trump says, okay, we're going to have the Federal Reserve printing money, but instead of giving it to the banks for the banks to provide more loans, and then unless we nationalize them and say, now you provide more loans, but if you don't, it does not work, then say, let's give it directly to the people. This is what we call QE for the people. And here, this is crazy. Look here, this is Mario Draghi. And when he was at the helm of the central bank, he said, and when we saw that, the economists, working banks or wherever, this is, we fell from our chairs. They said, you cannot be saying this. We are certainly considering these ideas, QE for the people, a central bank printing money and giving it to the public. Imagine, it's like Federal Reserve printing money and then going out in the street in Washington, everywhere, and saying, or using a helicopter, stuffing a helicopter with banknotes and then flying over the cities and opening the windows. This is completely crazy. But now this was completely unthinkable. This is why the period we are in now is really very, very interesting and completely unthinkable before the COVID-19. And then now people are talking about it and say, we can do it. We can do it, but if we do, we have to bear in mind that this is a high risk strategy. And here we're talking about the risk of monetizing the debt. Basically,
just Michel, one question. So this QE for people, practically how it is done, that means it's, for instance, it's when the central banks are like the Fed. Now I know that the Fed is buying either on the primary market, they are directly buying the corporate bonds, right? They are not even going on the secondaries. They got some facility for buying new issue bonds from enterprises. Is it what you... Is this QE for people way to?
The QE for the people here would be a way for instance, there's an idea to do it in Switzerland. Even the central bank, a way to give it directly to the people is not actually to use a helicopter. This was the image used by Milton Friedman, who was a famous Nobel Prize in monetary economics. And he used this idea, he meant it as a joke. People believe that when you want to inject liquidity, you use helicopter and you fly over the cities and you open the windows. It's not exactly how you proceed. But nowadays, a way to do it is, okay, not to use a helicopter, but to print money and give it to the people in the form of, say, paying for their health insurance. So you could have the central bank here in Switzerland, it generates profits and it gives part of those profits, the idea, to the cantons, or it can use it also to give a check, provide a check to the Swiss households, which would go and pay maybe half of the bill of their health insurance. So this is one way of bypassing the banks, using the money from the central bank and giving it straight to the households. And then we talk about the risk of doing the same, but here instead of the household, we're talking about the governments. And here we talk about monetizing the debt. What do we mean by that? It's actually the money printed by the central bank is used to pay the spending of the governments. And clearly then the risk here is what we call monetizing the debt, is that you get into hyperinflation. And here I show you some examples of hyperinflations. There are 30 of them. They all took place in last century. The last one here was Zimbabwe in 2007. And here, look here, the numbers, they are mind-boggling here, 10.2 to the power 10. So here we're talking about billions of increase of inflation per month. The highest one was actually in Hungary. I had a relative coming and he lived there during this period. He was a little boy and he told me the story that he wanted to go to the cinema, and he came back home and asked money to his dad, and by the time he returned to the cinema, the price had gone up. So here we're talking about inflation rate, which is constantly adjusted. And the case that everyone talks about when we talk about hyperinflation is Germany, the Weimar Republic in the 1920s, 1923. And all these cases happened when money was what we call fiat money, so not pegged to something like gold, for instance, so completely free. And at one point, the government takes control, goes to the central bank and say, now you print money and you give it to me. Here in Germany, Germany had to pay les réparations, you know, to the Allies for the First World War. And they started by paying with gold, and then when they were out of reserves, then they said, okay, you want money? We're going to pay. Reichsmark, print them, print, and give it. Obviously, there's a rule, just basic rule of supply and demand. The more you print money, the worthless it becomes. And at one point, all this money, paper, is just paper, and people start wondering, how much is it value? What's the value of a currency? And it doesn't have the value of the ink which is used to print it. And then people start getting scared. They take a salary and they rush to the shops, and we've seen that already, you know, the panic buyings. People buy rice, buy pasta, and they store it because they fear that at the end of the month the prices will be higher. And then you get into a virtuous circle. People ask to be paid every week instead of every month, and do the same every week. And so the shops get empty and prices start going up, and then you get into an acceleration. So all these cases here happen when the central bank was no longer independent and had to finance government spending. So monetizing the debt bears this risk, and it's a very important risk. At one point, people lose confidence, and you get into this hyperinflation scenario. This is what we call a black swan. A black swan is something that we observe seldomly, at least here in our parts of the world. When you go to Australia or New Zealand, actually it's the rule that swans are black and not white. But anyhow, we refer to the black swan as a very unlikely event. But if it happens, it's very, very, produces a lot of damage. This is Fukushima in Japan that triggers a Japanese recession, or the COVID-19, which infects global growth. So, Emmanuel, you were talking earlier on about what the Fed is doing. If you look at the balance sheet of the Fed, remember those $7,000 billion I showed you just earlier on, and look at the increase we had in just 2 months. March, this is where we're staying at 4 point something, and now in just 2 months, the balance sheet of the Federal Reserve has almost doubled. This is QE infinity. We're talking about monetary bazookas, but here it's not a bazooka. This is nuclear. The Federal Reserve has gone nuclear. And look here, this is the treasury. So the government bonds it's buying. These are other bonds it's buying, mortgage-backed securities. Look here, roughly half more than half of its balance sheets are those bonds. It's buying, I saw in here, this year, it's buying 3/4 of the bonds issued by the governments. 3/4 of those bonds are bought by the Federal Reserve. So clearly here, this helps. If you're buying bonds, the price of the bonds goes up, which means that the yield of the bond goes down. So this is what is keeping the whole thing in check. Indeed, Japan has been doing that for years and years and years. It's the central banks which is buying government bonds, so yields can be down and so the debt can be affordable. So this is the good side of the story. But the bad side of the story is that indeed you're monetizing the debt and you're just asking the central bank to print money and buy the bonds which the government is issuing to pay for its debt. Clearly, at one point, you run the risk of saying, what is money worth? And you run the risk of excessive inflation or even hyperinflation. So my conclusions, Corona recession, likely to be severe. Indeed, we are right in the middle of it. But I'm really confident that it's going to be short-lived and we'll already start recovering. In some countries like China, the recovery is underway. In other countries, Europe, also the US, we are gradually going to recover. If I have to choose between fiscal reflation and monetary reflation, I would clearly be, and normally I'm more in the monetary camp. But clearly, and that's something I did not talk today, but when you look at the how efficient, how effective monetary policy is versus fiscal policy, we have to take into account the fact that interest rates are very low, and the lower they get, the less effective monetary policy becomes. We talk of a liquidity trap. So when interest rates are at rock bottom, as they are now, monetary policy, you need even more. This is why we get these huge numbers of expansion of the balance sheet, because it's not working. So what you do is, this is like, you know, injecting dopamine and for you know, people doing a sport competition. It's not working, so what you do is you inject even more. So if I have to choose between the fiscal policy and the monetary policy, I clearly choose today the fiscal reflation, i.e. the expansion of the fiscal policy. And I believe you can even make sure that you get to a fiscal multiplier closer to 1, possibly even slightly above it, which would mean that debt pays for itself. You increase debt, but you also boost growth. So all in all, you get what Roosevelt got in his years, in his period, a stable debt to GDP ratio. Here we see these banks, central banks, doing bazookas, making statements, whatever it takes, going nuclear, but really deep down they're short of ammunitions, as we say, short of ammunitions. And clearly here, what I'm really scared is that this is what monetizing the debt, not he debt. There's a nice expression I heard recently from a minister in France. It says, when the house is burning, you don't count the liters of water that you're using to extinguish the fire. I say, correct. But when you do extinguish the fire, make sure that you don't keep injecting that liquidity. Maybe the horse or the donkeys will not drink. And maybe if you keep injecting that liquidity and monetize the debt, you will encounter severe problems like the one I just mentioned of hyperinflation. But I believe, and let's end on a positive note, that indeed at central banks, they're not dummies. They know all this, and clearly they monitor. They are very reluctant to, this is why Also, we see a lot of tension in Germany. You may have saw this, that there's actually a ruling, a case in court at Karlsruhe in Germany for people who are saying the European Central Bank is going too far in buying all these bonds. It's not in its mandate, and we clearly run the risk of monetizing the debt. The German obviously know what they're talking about, have gone actually through a period of hyperinflation, and since then they're really scared that they might experience that. So unless there's obviously always a risk that at some point the government says enough with central bank independence, and indeed this risk exists. Back in 2004, we saw that in Japan, the minister Abe fired the president of the central bank because he was not printing enough, and he put a friend in his place, and he told him, you're going to print and you're going to double money supply. And indeed, this is what the central bank did. So clearly there, the risk is that at some point, central banks are no longer independent and the government takes control. But let's be optimists and exclude that for the time being and say this would be really like a complete crisis situation, war type situation. So let's keep that as a black swan, something very, very unlikely.
Thank you, Michel. So we are a bit after the schedule, but I will ask you, let's say, one or two questions. So there were some interesting questions from students, and you can see that inflation is back in their mind. So there were some questions about how do you counter inflation when pouring money into the economy. Another question related, if there is high inflation after the crisis, won't it help the debtors and the government since the value of debt the government has to pay will reduce? So you can see that basically there is this inflation concern. So I have, in fact, just to synthesize, I have two questions, right? The first will be, what will be the future after the COVID-19? Would be in inflation or deflation mode, right? So
right.
What are your views about those two possibilities? Yeah. Because we see one force, which is basically this monetization of the debt. I was reading an article yesterday on the FT where basically the OECD have make an evaluation, and they think that on the top of the amount that you were presenting, there might be 17 trillion more of debt to add on it. So the bill will be pretty high. So the first question is inflation versus deflation. And the second question, which is related, how and who will pay the bill? Because at the end of the day, somebody needs to pay. So would it be the taxpayers? That means increase of the tax? Would it be the savers, the inflation? Would it be debt relief? You can see that, for instance, IMF and World Bank are for the emerging countries are going to debt relief. So two questions. The first is, what is our future like? And the second, who will pay the bills?
Right. On the first question, inflation versus deflation. On inflation, I believe there are three types of inflation. There's the good, the bad, and the ugly, to make a reference to the famous Western movie. The good inflation is the one which is due to an overheating economy. There's too much demand in the system. People shop, go on a spending spree. They buy Porsche or Mercedes. They buy chalets in Verbier. They spend like mad, and the suppliers cannot follow on this increased demand, so the prices go up. This is the dream for inflation for a central bank, is when the economy works too well, overheating, what you do, you close the liquidity tab, you raise interest rates, the donkeys or the horses stop providing credit to the economy, and the economy slows down and inflation comes down. That's the good inflation. The bad inflation, it comes from, this is demand pull inflation, the good inflation. The bad inflation is cost push. It's due to the increase in oil prices or raw materials, but more often than not, we're talking about oil prices. Here, why is it bad? because that inflation can come even if there's lots of unemployment in an economy. So you get this cost push. In the 70s, we had these oil shocks, and that triggers severe recessions. The ugly inflation is the one I just alluded to, also materializes in an economy which is not at full employment, just because central banks are printing money and monetizing the debt, and you get the ugly inflation, the hyperinflation. So clearly now, of these three types of inflation, the most likely we're going to get is the first one, but not inflation, but disinflation. I mean, lower inflation. You can see that here. The expectations are going down and are staying low. And so we may expect demand to be sluggish. And so deflationary or when you talk, I don't like to use deflation. Deflation actually means negative inflation and falling output. Here we're talking about disinflation, i.e. lower inflation. Inflation remains positive, but is lower. So we can expect from the economy side, demand to be sluggish, recovering, but being certainly not overheating an economy. And so the trend towards disinflation. With the risk, low probability risk, that we can get some ugly inflation if we monetize the debt. This is my scenario. So the central scenario is disinflation, but let's remain wary that at some point down the road, if central banks don't reverse their liquidity injections once the economy has recovered, then we may have to cope with the ugly inflation.
But Michel, there might be another possibility to extreme in the other way. That means that, for instance, due to the uncertainties, the corporations do not invest. So, and that consumers stop to consume and save for precautionary measures. So you can be in the deflation stage too. That means the demand is in fact impacting negatively due to the COVID-19 and due to the fact that people are a bit scared and instead of consuming, they save, and instead of investing, that means they don't invest for the corporations. Is it something that you consider too?
Yeah, but if you recall what I just showed with talking about fiscal multiplier, when I was studying that, when I was a student, there was a famous academic paper by Professor Barrow, who's also been doing now some research on a very interesting piece on the COVID-19 implication for the world economy. He came with a paper saying that when you do this kind of policy, it does not work because people get a check from the government, a gift, but then they save it because they say, the government is making a gift now, but he's going to tax me in a few years. So I won't use that money. I put it in my bank account, save it, and keep it for the tax that will come in a couple of years. This is a theory. In practice, especially in the US, you know how people love living on credit, and we pay now, we use the money now, and we'll see tomorrow if we can pay for it. So, so clearly here, I believe that especially if you look at the type of policies which are being implemented and targeting the low-income part of the population, this is where it will have most impact, and marginal propensity of consume of these people is certainly much larger than if you're doing tax relief for the wealthy. So I don't see really that risk that the money would be mostly saved if you act again on the front of these people here as opposed to these people here.
So last question, who pays the bills? And that means, will it be the workers, the taxpayers? Will it be the savers?
Who pays for the bill? Well, the bill, as we saw, where is it? Here, and I said it's manageable. Here, basically, we can say this will increase. So the savers who will purchase the bonds issued by the governments who will pay for the bill. If at one point we believe that this debt is not manageable and we need to reduce it and we need to pay for it via tax increases, we can, but then let's make sure that we do so when the economy is solid enough to be able to stomach increases in tax rates. A way also to get more taxes is obviously through increased growth. And indeed, this is the whole idea of this debt to GDP ratio falling, not because you have austerity, but this is what we call supply side economics, very popular in the US under Reagan, and even Bush, President Bush tried it, is that basically you say you reduce taxes, it will boost economic growth with a multiplier larger than 1. So in the end, you collect more taxes, because if you have growth, then people pay taxes. So here, clearly, as we get into recovery, you get more taxes from this economic growth. So it's a combination of largely bond savers who will finance the spending by purchasing government bonds. The taxpayers, I would clearly not do it now, because this would be repeating the same mistake which was done in the 30s by Hoover, and this would really trigger, make that the recession becomes a depression. And the last one I want to see paying for the debt are the central banks.
Okay, thank you very much. So thanks again, Michel. Thank you very much for all those very, very interesting insights. Thanks to all the participants. This is the end of this second macroeconomic webinars, and stay tuned for the next webinar. Thank you. See you for next one. Bye.
Thank you all. Bye-bye.